Tad, you and I were just saying that when you come to the conference, you're a bond guy. You guys talk about the same thing, which is bonds and rates and where they go next. But this year, the conversation very much is on how we're in the late stage of the credit cycle. So from your standpoint, what does that mean in terms of how you position yourself?
Yes, well, as you say, it is our view that we've moved into the late stages of the cycle, and that does seem to be more confirmed by the behavior of the financial markets, behavior of investors. What it tells us is that if you're going to think about your allocation to fixed income, or maybe indeed to risk assets generally, you should think about it as a sort of a rational allocation over the course of the whole cycle. So simply put, take your risk abundant and early in the cycle. You should still be risk on maybe in the mid stages of the cycle, maybe be a little bit more discriminating, a little bit more prudent. But in the late stages of the cycle, what you're really trying to avoid is loss of principal or permanent impairment of principal. So you need to be defensive, and that means high grading portfolios and avoiding the areas that are probably more at risk with respect to losing principal.
So based on what we've seen in the past, how long can we expect the late cycle to last for?
Well, we've been of the view that we've been in a late cycle environment for a while, so we're probably not the best judge of how much longer it can go on, but I think that the whole cycle has been unnaturally prolonged by the behavior of central banks. Of course, that's changing here in the U.S. with Fed policy. We are beginning to see the other side of the mountain with respect to quantitative tightening versus quantitative easing, and we are seeing some increase in rates. That hasn't quite been echoed on the part of the other central banks, but I think that we are unabashedly tiptoeing in the direction of what's inevitable, which is a deleveraging type of environment.
And that's something you've been warning about for years, risks from over-leveraged corporate debt and central bank policies that have repressed interest rates overall. Are there signs of investors who are unprepared for an eventual downturn? I know you recommend being cautious, but do you see behavior in the markets that suggests investors aren't ready?
I don't think investors are ever ready, and probably none of us are ever ready, but I think part of what you may be speaking to is that even as the narratives start to shift, I feel like I read much more about people discussing the potentiality of late cycle type of environment. I don't get the sense that it's really reflected in the positioning so much. And you can judge that pretty well because in a year that has had as much volatility as 2018 already has had, you're not really seeing much in the way of the credit markets widening or increasing risk premium. It's been, relatively speaking, fairly steady as she goes type of performance, very much at odds what we think as a proper response to the macro environment.
Some would say that the rise or the comeback of covenant light loans is a really big red flag. Why do you think they've made such a strong comeback, and how does this all resolve itself?
Well, it'll resolve itself ultimately pretty badly in our view, and maybe it's worth saying a couple of words about covenant light loan issuance because, as you say, it has proliferated in a very dramatic way. It was not a traditional way of underwriting ever, and the reason it's so consequential is because as a bond investor, the company's obligation to you is always contractual. It's just what essentially the bond says the company has to do. The company is always fiduciary to the equity owners. So if you, the bondholder, are buying covenant-like debt, you have shorted a lot of optionality back to the company. So the management is almost required to use that optionality to the advantage of the equity holders and against that of the bondholders. So you can look at the company and do very surface level credit analysis, and you can say, oh, it has an interesting business here, it has good cash flow over there. But if your bonds are covenant light, you may never have the ability to connect your bonds to those assets. Those assets will be sold, special dividends made to the shareholders, a borrowing may be made, special dividend to the shareholder, and you, the bondholder, are left holding the bag. That's the way it traditionally works.
That's a great explanation. Does credit still lead? I mean, there's a market adage that credit always leads, but does it lead right now?
It hasn't been, actually. I think that the equity market is where the volatility has most recently manifested itself. I think it's disturbing, actually, in a way, because the credit markets, as you say, are sort of the traditional bellwether that when credit is like the foundation of the house. And when there's cracks in the foundation, and we do see the cracks in the foundation, it means that the house, no matter how beautiful it is or how attractively decorated, it's ultimately going to collapse in a end of cycle type of deleveraging. I think it's largely because of the habituation of credit market investors to risk that has been supported by central banks that people are very used to the idea that probably nothing adverse is going to happen to them. And that's exactly, gets back to your point earlier. So are investors prepared? Maybe not.
All right, there's that recency bias at work. We have not seen a bond bear market since the late 70s. As we think about a bond bear market that's coming, what are you most concerned about?
We have a long period of time, as you alluded to, in which we were working with emergency monetary policy and a level of rates that hasn't been experienced at least in 100 years. Some have even commented that maybe it's been centuries since we saw 0% rates and maybe never since we saw negative rates. So you have a financial market and a macroeconomic environment that is probably acclimated, has co-evolved, so to speak, with a low rate type of environment, so that even a very modest increase in rates, I mean, you think about it, right? I mean, we're sitting here in a place that had a conference decades ago when interest rates were at 15%, and we're talking about 3% rates now as being high. I mean, it's a romper room version of a bond bear market, and yet the general economy and the financial markets are already beginning to vibrate under the stress of even a modest increase in rates.